A royalty is a payment made by one party, the licensee or franchisee, to another that owns a particular asset. The licensor or franchisor for the right to ongoing use of that asset. Royalties are typically agreed upon as a percentage of gross or net revenues derived from the use of an asset, or a fixed price per unit sold of an item of such. But there are also other modes and metrics of compensation. A royalty interest is the right to collect a stream of future royalty payments. A license agreement defines the terms under which a resource or property are licensed by one party to another, either without restriction or subject to a limitation on term, business or geographic territory, type of product, etc. License agreements can be regulated, particularly where a government is the resource owner, or they can be private contracts that follow a general structure. However, certain types of franchise agreements have comparable provisions. Non-renewable resource royalties. A landowner with petroleum or mineral rights to the property may license to another party rights to extract those resources in exchange for a resource rent, or a royalty on the value of the resources sold. When a government owns the resource in question, the transaction is often subject to legal and regulatory requirements. In the United States, fee simple ownership of the mineral is possible by a private individual. Therefore, payments of mineral royalties to private citizens occurs quite often. Local taxing authorities may impose a severance tax on the unrenewable natural resources extracted from within their authority. The federal government receives royalties on production on federal lands, managed by the Bureau of Ocean Energy Management, Regulation and Enforcement, formerly the Minerals Management Service. An example from Canada's north is the Federal Frontier Lands Petroleum Royalty Regime. The royalty rate is determined as an incremental rate from 1 to 5% of gross revenues until costs have been recovered, at which point the royalty rate increases to 30% of net revenues or 5% of gross revenues. In this manner, risks and profits are shared between the Government of Canada and the petroleum developer. This attractive royalty rate is intended to encourage oil and gas exploration in the remote Canadian frontier lands where costs and risks are higher than other locations. In many jurisdictions, oil and gas royalty interests are considered real property under the NAICS classification code and qualify for a 1031 like-kind exchange. Oil and gas royalties are paid as a set percentage on all revenue, less any deductions that may be taken by the well operator as specifically noted in the lease agreement between the well operator and the mineral right owner. The revenue decimal, or royalty interest that a mineral owner receives, is calculated as a function of the percentage of the total drilling unit to which a specific owner holds the mineral interest. The royalty rate defined in that owner's mineral lease, and any tract participation factors applied to the specific tracts owned. As a standard example, for every $100 bbl of oil sold on a U.S. federal well with a 25% royalty, the U.S. government receives $25. The U.S. government does not pay and will only collect revenues. All risk and liability lie upon the operator of the well. Royalties in the forestry industry are called stumpage. Patent royalties. An intangible asset such as a patent gives the owner an exclusive right to prevent others from practicing the patented technology in the country, issuing the patent for the term of the patent. The right may be enforced in a lawsuit for monetary damages and/or imprisonment for violation on the patent. In accordance with a patent license, royalties are paid to the patent owner in exchange for the right to practice practice one or more of the four basic patent rights: to manufacture with, to use, to sell, or to advertise for sale of a patented technology. Patent rights may be divided and licensed out in various ways, on an exclusive and non-exclusive basis. The license may be subject to limitations as to time or territory. A license may encompass an entire technology, or it may involve a mere component or improvement on a technology. In the United States, reasonable royalties may be imposed both after the fact and prospectively by a court as a remedy for infringement. In patent infringement lawsuits where the court determines an injunction to be inappropriate in light of the case's circumstances, the court may award ongoing royalties, or royalties based on the infringer's prospective use of the patented technology. As an alternative remedy, at least one study analyzing a sample of 35 cases in which a court awarded an ongoing royalty has found that ongoing royalty awards exceed, by a statistically significant amount, the jury-determined reasonably royalty. Patent royalty rates. The following are prevalent rates within the United States: a pending patent on a strong business plan, royalties of the order of 1%; issued patent 1% plus to 2%. The pharmaceutical with preclinical testing 2 to 3%. With regards to the actual rates of royalty payments in the industry, the Licensing Economics Review reported in 2002 that in a review of 458 license agreements over a 16-year period, it found that an average royalty rate of 7.0%. However, the range extended from 0% to 50%. All of these agreements may not have been at arm's length. In license negotiation, firms might derive royalties for the use of a patented technology from the retail price of the downstream licensed product. In the Arab countries, it may be found that a royalty as a percentage of sales may be difficult to transact. A flat fee may be preferred, as percentages may be interpreted as percentage of profit. Trademark royalties. Trademarks are words, logos, slogans, sounds, or other distinctive expressions that distinguish the source, origin, or sponsorship of a good or service. Trademarks offer the public a means of identifying and assuring themselves of the quality of the goods service. They may bring consumers a sense of security, integrity, belonging, and a variety of intangible appeals. The value that inures to a trademark in terms of public recognition and acceptance is known as goodwill. A trademark right is an exclusive right to sell or market under that mark within a geographic territory. The rights may be licensed to allow a company other than the owner to sell goods or services under the mark. A company may seek to license a trademark it did not create in order to achieve instant name recognition rather than accepting the cost and risk of entering the market under its own brand that the public does not necessarily know or accept. Licensing a trademark allows the company to take advantage of already established goodwill and brand identification. Like patent royalties, trademark royalties may be assessed and divided in a variety of different ways, and are expressed as a percentage of sales volume or income, or a fixed fee per unit sold. When negotiating rates, one way companies value a trademark is to assess the additional profit they will make from increased sales and higher prices method. Trademark rights and royalties are often tied up in a variety of other arrangements. Trademarks are often applied to an entire brand of products and not just a single one, because trademark law has as a public interest goal of the protection of a consumer in terms of getting what they are paying for. Trademark licenses are only effective if the company owning the trademark also obtains gains some assurance in return that the goods will meet its quality standards. When the rights of trademark are licensed along with the know-how, supplies, pooled advertising, etc., the result is often a franchise relationship. Franchise relationships may not specifically assign royalty payments to the trademark license, but may involve monthly fees and percentages of sales, among other payments. Trademark royalty rates. In a long-running dispute in the United States involving the valuation of the DHL trademark of DHL Corporation, it was reported that experts employed by the IRS surveyed a wide range of businesses and found a broad range of royalties for trademark use from a low of 0.1% to a high of 15%. Franchises. While a payment to employ a trademark license is a royalty, it is accompanied by a guided usage manual, the use of which may be audited from time to time. However, this becomes a supervisory task when the mark is used in a franchise agreement for the sale of goods or services carrying the reputation of the mark. For a franchise, it is said, a fee is paid, even though it comprises a royalty element. To be a franchise, the agreement must be a composite of the items: the right to use a trademark, to offer, sell or distribute goods or services, payment of a required royalty, a fee, significant assistance or control with respect to the franchisee's business. One of the above three items must not apply for the franchise agreement to be considered a trademark agreement. In a franchise, for which there is no convention, laws apply concerning training, brand support, operating systems, support and technical support in a written format. Copyright. Copyright law gives the owner the right to prevent others from copying, creating derivative works, or using the works. Copyrights, like patent rights, can be divided in many different ways by the right implicated, by specific geographic market territories, or by more specific criteria. Each may be the subject of a separate license and royalty arrangements. Copyright royalties are often very specific to the nature of work and field of endeavor. With respect to music, royalties for performance rights in the United States are set by the Library of Congress, a copyright royalty board. Performance rights to recordings of a performance are usually managed by one of several performance rights organizations. Payments from these organizations to performing artists are known as residuals and performance royalties. Royalty-free music provides more direct compensation to the artists. In 1999, recording artists formed the Recording Artists Coalition to repeal supposedly technical revisions to American copyright statutes which would have classified all sound recordings as works for hire, effectively assigning artists copyrights to record labels. Book authors may sell their copyright to the publisher. Alternatively, they might receive as a royalty a certain amount per book sold. It is common in the UK, for example, for authors to receive a 10% royalty on book sales. Some photographers and musicians may choose to publish the works for a one-time payment. This is known as a royalty-free license. Book publishing royalties. All book publishing royalties are paid by the publisher, who determines an author's royalty rate, except in rare cases in which the author can demand high advances and royalties. For most cases, the publishers advance an amount which can constitute the bulk of the author's total income plus whatever little flows from the running royalty stream. Some costs may be attributed to the advance paid, which depletes further advances to be paid from the running royalty paid. The author and the publisher can independently draw up the agreement that binds them or alongside an agent representing the author. There are many risks for the author. Definition of cover price, the retail price, net price, the discounts on the sale, the bulk sales on the pod platform, the term of the agreement audit of the publisher's accounts in case of impropriety, etc., which an agent can provide. The following illustrates the income to an author on the basis chosen for royalty, particularly in POD, which minimizes losses from inventory and is based on computer technologies. Hardback royalties on the published price of trade books usually range from 10% to 12.5%, with 15% for more important authors. On paperback it is usually 7.5% to 10%, going up to 12.5% only in exceptional cases. All the royalties displayed below are on the cover price. Paying 15% to the author can mean that the other 85% of the cost pays for editing and proofreading, printing and binding, overheads, and the profits to the publisher. The publishing company pays no royalty on bulk purchases of books since the buying price may be a third of the cover price sold on a singles basis. Unlike the UK, the United States does not specify a maximum retail price for books that serves as base for calculation. Royalties based on net receipts. Methods of calculating royalties changed during the 1980s due to the rise of retail chain booksellers, which demanded increasing discounts from publishers. As a result, rather than paying royalties based on a percentage of a book's cover price, publishers preferred to pay royalties based on the net receipts. According to the Writers and Artists Yearbook of 1984, under the new arrangement, appropriate adjustments are of course made to the royalty figure and the arrangement is of no disadvantage to the author. Despite this assurance, in 1991, Frederick Nolan, author and former publishing executive, explained that net receipts royalties are often more in the interest of publishers than authors. It makes sense for the publisher to pay the author on the basis of what he receives, but it by no means makes it a good deal for the author. Example: 10,000 copies of a $20 book with a 10% cover price royalty will earn him $20,000. The same number sold but discounted at 55% will net the publisher $90,000. The author's 10% of that figure yields him $9,000. Which is one reason why publishers prefer net receipts contracts. Among the many other advantages of such contracts is the fact that they make possible what is called a sheet deal. In this, the publisher of that same 10,000 copy print run can substantially reduce his printing cost by running on a further 10,000 copies, and then further profit by selling these sheets at cost price or even lower if he so chooses to subsidiaries or overseas branches, then paying the author 10% of net receipts from that deal. The overseas subsidiaries bind up the sheets into book form and sell at full price for a nice profit to the group as a whole. The only one who loses is the author. In 2003, two American authors, Ken England and Patricia Simpson, successfully sued HarperCollins for selling the work to its foreign affiliates at improperly high discounts. This forced a class action readjustment for thousands of authors contracted by HarperCollins between November 1993 and June 1999.